I just want to welcome all of you here today. We're having this webinars. Like I said before, these are meant to edify our communities. They are meant to make our people know how, we want to know how these things work. Information is key. Information is everything. And the reason we're having these meetings is just to tell you some of the things that we know are out there that I believe not everybody knows about it. This is something that the top 1% have been using for years and years and years. And now we want to be able to also take advantage of it. And that's why we're giving this, we're making it mainstream. So what we're talking about today is we're going to be, why is structure important? And the reason I give this video, I talk about these things, these are questions that are coming to me from clients. Clients talk about these things, and then we think, okay, if a client is talking about this thing, and if we see these things becoming an issue, then we want to also, we know that if one person is talking about it, then there are hundreds of people out there who don't understand these things, and we want to throw it out there so everybody who is willing and able should be able to know what it's all about. So today we're talking about structure. Why is structure important? And how should I structure my rental properties to save on taxes? And so I'm going to start by sharing my screen so we are all looking at the same thing and we're all on the same page. So I'm going to share my screen. Just give me a second. The way we're going to go with this presentation is that I will go through the entire presentation, and at the end of it, I will take some questions. And then if you have any questions, we'll answer those questions, and then that is the process. And I want you guys to stick around because, as always, at the end of my presentations, there is always something that we want to add out there. There's always value, something that you're going to take away towards the end of the presentation. So there are giveaways at the end of the presentation, something that you can apply for yourself immediately. So I want you to stick around till the end of the presentation. So I'm sharing my screen for you guys. Let's see. So the topic today is something I'm passionate about. I am very keen into real estate. So why is structure important? Structure is everything. And how should I structure my rental properties to save on taxes? Yeah, so my name is Charles Njoya. I'm a CPA. I'm a certified tax advisor. I'm a wealth coach, and I run this company called CHN Advisors. So today we're going to be talking about one thing. So we're going to be talking about structure. The questions we're going to ask, the question we generally ask ourselves is, what is structure? For me, structure is everything. And if you ask anybody, when you're building like a property, when you're building a house, the type of house you're building will determine the foundation. This is the same with a business. The mission determines the structure. So when we think about structure, structure is everything in everything we do. And especially from a compliance standpoint, from a tax mitigation standpoint, from a wealth building standpoint, structure is everything. You want to think about the overall goal. The overall goal, is our business, is it for profit or is it a non-profit? Is it for the benefit of the community or is it for the benefit of yourself? If it's a benefit for the community, the risk is a lot less when it's for the benefit of the community, even though there are rules that you have to make. Less compliance requirements, as long as you do not forfeit the purpose when it comes to community building. That's where we have the Form 990. That's where we're talking about nonprofit. The nonprofit structure is a design from the IRS. So you have something that you're giving to the community, and then the IRS now gives you certain things that you can take advantage of. So again, when your overall goal is to provide value to the community, then there are less compliance requirements as long as you do not forfeit the purpose. Okay, so for example, If you start taking money out of a nonprofit, you will forfeit the purpose and you will lose the nonprofit status. And what happens? That is what you call illegal transaction. So it's important. Who benefits? Is it the community or is it you? Another thing we talk about here, so we want to think about this very carefully. Today, we will focus on for-profit businesses. That is where you get higher exposure, especially when it comes to taxes. So we're not going to be talking about nonprofits. We're talking about for-profits because most of us here, we're talking about taxes, and nonprofits don't have any tax exposure unless you forfeit the purpose of the or you do something that is an illegal transaction, and then you will then forfeit the purpose of the company, of the structure. Another thing you want to talk about is, what do you really want to achieve is so important. What are the risks associated with the business you are engaging in from a compliance standpoint, from an asset protection standpoint, from a tax mitigation standpoint, from an asset accumulation standpoint? Even though there are risks associated with the, with the consulting business, for example, it is far less riskier than maybe a trucking business or a medical practice or a restaurant business. Why? Because when you're doing consulting, I think you are not exposed to a large community of people. When you are in medical practice, the risk is far more than if you were doing your consulting and you were consulting for a single entity. Or maybe you are in a restoration business and you're serving thousands of people. The risk is far more, you have far more exposure. And here you have to be very careful of the type of structure. You think about things like profitability. When you think about profitability, is your primary objective to generate an income, to be profitable? Those are the type of things you consider when you think about it, when you're talking about the structure of a business. When you are making profits, you're generating income. Tax mitigations become critical because you're generating income. Remember, I tell you, income pays a lot of taxes. When you start mitigating, when you start building assets, generally you're transferring some of the tax liability to the third party who are using those assets. So that is where the big portion of mitigation comes in. When you mitigate taxes, you use the proceeds to help. I mean, this is how we operate. We basically help you when you start building profitability. Your problem becomes tax mitigation. When you mitigate taxes, how do we mitigate taxes? We avoid you paying those taxes. And when you avoid paying taxes, what you should be doing is to use those proceeds, use those tax savings to help in acquiring even more assets. So that what do? They avoid even more taxes. And in the process, you're building more assets. That's the way the wealthy operate. Then you need to protect assets. Now that you've got profitability, you have profits, you've made income. So basically, when you have income, you start thinking about tax mitigation. And when you mitigate taxes, what do? You buy assets. Basically, you're buying assets. And when you buy assets, you're thinking about tax, you're thinking about asset protection. Now, because you've had assets, you've started accumulating assets. And when you accumulate assets, it's all about wealth building. Again, we're talking about structure. So one of the things I'm going to tell you is, when we talk about, when you talk about wealth building has 3 stages. You generate income, you can accumulate assets, and then you're not concerned about protecting those assets. You only think about asset protection when you have started accumulating assets. People come to me and they want to do many things. They've not started even accumulating assets. When you don't have any assets, what's the risk? your risk is very small, your exposure is small. So basically, you start thinking privacy when you've started accumulating assets, how you structure those assets to be able to take advantage of those three things I said before, to be able to, you protect those assets so that the objective is to build a legacy, to build wealth. When you make money, you are constantly under the threat of a lawsuit. Even the IRS can make you bankrupt. So basically, that's why we talk about these things. So another thing I'm going to talk about here is the different structures that we have. The first structure that you always have when you start a business, most people start as a sole proprietorship. When you talk about sole proprietorship, it's a DBA. It is same as a single member LLC. When you have an LLC and it's a single member LLC, it operates as a sole proprietorship and it's a Schedule C. You do not need any form of registration when you're a sole proprietor for most businesses in America. Basically, all you need is a seller. You need a buyer. Then there is business. Once you can exchange transactions, then there's a business. People come to me all the time and they say, Charles, I want to create this business. What do I need to do? I say, go make money. Go start making money. As soon as you start making money, there is a business. Then we can structure you. I mean, again, this is not for all businesses. There are some businesses that you have to basically go through certain compliance requirements before you even start. But for the majority of the businesses I see, you just need to go out there and start doing business. It's a sole proprietor. It's under your own social security number. So the only thing, when you talk about DBA with a sole proprietorship, you're basically just trying to protect the name of the business. That's what the DBA does. Another thing is partnerships. When you talk about a partnership, I mean, with a DBA, with a sole proprietorship or a single member LLC, it's usually a Schedule C. You file a Schedule C on your individual tax return. That's the way it is. So when you talk about a partnership is the same as a multi-member LLC. When you have a multi-member LLC, the IRS doesn't know any, the LLC doesn't mean much to the IRS. If it's a multi-member LLC, the IRS defaults it to a partnership. And the partnership, you're filing something called a 1065. It's a pass-through entity. Pass-through meaning that the entity itself doesn't pay taxes. It provides you a Schedule C for your it provides you a K1 for your personal income taxes. That's what you get from a partnership. Whether you're in a partnership with, the partnership could be in any form. You could have a partnership with another business. You could have a partnership even with your retirement account. You can have a partnership where you're doing, your retirement is basically investing in your business. So it could be a partnership, and every person who has interest in that business gets a K1. And then it's a 1065 separate tax return that is filed in this case. Now, the main difference, then the next one we talk about is generally an LLC. An LLC is a state registration. Every state gets its own. You have to register an LLC in the state in which it's operating. And then it could be if a single member LLC or it's a multi-member LLC. Like we said before, a single member LLC defaults to a Schedule C. It's a sole proprietorship. And a multi-member LLC defaults to a partnership. And then we can talk about different structures that will that will come from this, because an LLC gives you the ability to elect. You may elect to file as an S Corp when you have an LLC. And generally, I tell people that you want to elect to file as an S Corp when it is beneficial for you to file as an S Corp. When you have a business, and then you started that business, maybe it's a sole proprietor, maybe you have an LLC, which is a single member LLC. Normally, it defaults to a Schedule C on your personal income tax return because it is what you call let's forget about it. I just missed it. But what do you do with an LLC? An LLC defaults to a single member LLC. It's a single member LLC is defaults to a Schedule C on your personal income tax return, or if it's a multi-member, maybe 2 people own it or 3 people. If it's a multi-member, it defaults to a what? To a partnership. But the LLC gives you one additional thing. You may elect to file as an S Corp. And when you elect to file an LLC as an S Corp, what it basically does, there's a form called 2553. When you file that form, the IRS allows you now, you are now able to file as an S Corp. So which means you're going to file a separate tax return, which is what? An 1120S. The main difference from a tax standpoint between an S Corp, and then there's another one, we'll talk about that one. It's basically a C, we have the S Corp. The S Corp is generated from what? It's generated from, you could actually, basically with an S Corp, you can register an S Corp from the outset. You can register your business as an S Corp, a corporation, and then you elect to file as an S Corp because S Corp is the election. Or basically, you can basically elect an LLC to be filing as an S Corp. So an S Corp, there's something, so you have an S Corp, you have also a C Corp. The main difference from a tax standpoint between an S Corp and a C Corp is that S Corp is a pass-through entity and it files an 1120S. The C Corp, it's a separate entity on its own. It's filing as a separate legal entity. It pays its own taxes. And then with a C Corp, one of the things that people don't generally go for C Corp is that you get what you call double taxation with a C Corp. What is double taxation? I mean, the C Corp currently in the US, you pay 20. It's a flat tax rate of 21%. But also, every time you get shareholders take a dividend out of the C Corp, they are also being taxed because it's a capital gain. Basically, whenever you get a dividend from an S Corp, you're taxed again. That's why they say the disadvantage of a C Corp is double taxation. Are we together? So, another one, which is another structure that you get, we get something called COPE entities. This is called a charging order protection entity. A charging order protection entity is only available in certain states in the United States. Not every entity has that. It's a form of an LLC, but it gives you an additional level of protection. It's a higher level of protection. I think there are only 5 states currently that have that code. When you have an LLC, it protects you from the inside. What does that mean, protection from the inside? It means that if the entity, if there is something that happens within that entity, let's say somebody was driving, let's say somebody was delivering merchandise for your LLC, and then he had an accident with another truck, and then there's a wreck, maybe somebody dies. What happens when you have an LLC is that protects that liability, that lawsuit that comes out of that particular incident is going to be limited to within the assets of that LLC. If the LLC is maintained correctly, it's important. There's something called management of your LLC. You want to make sure that you don't pierce your corporate veil just by not managing your LLC. Mismanaging your LLC means that the LLC would not exist in a case of a lawsuit. And those are something that we can talk about. So basically, when you have such a situation where it occurs within the LLC, an accident occurred, and there's liability that has arisen as a result of that, of activities within that LLC. The LLC, your liability is limited to assets of within that LLC. Now, with a COPE entity, which is a charging order protection entity, let's assume you are the one who had an accident or who had doing something else on your private time. Now you have a liability, you have a lawsuit from those same people, and they know that you own the LLC. If it's a COPE LLC, even though you had an incident out of the premise of the LLC, of the entity, that entity, there's a charging order that protects the entity. So as long as you're not taking money out of the entity, the third-party creditor, the third-party plaintiff cannot get access to your money, even though the courts have felt that you are going to pay them a certain amount of money or whatever it is. You're being protected from the outside. As long as you're not taking assets out of the entity, you're protected. That the assets of that entity is protected. That's why they say the code gives you an additional layer of protection. You have inside liability protection with the code, and you have outside liability protection with the code. Then one other thing that you will get, most of the people we work with, you get a family management company. A family management company basically manages your interests in all these other entities we already said. It's generally just maybe you could make it different forms, but in most cases, it's just a sole proprietorship that's created, an entity that's created, basically to manage your interest in that entity. And it's very important for tax planning purposes. So having said that, yeah, so those were basically the different structures that we have that we can talk about. There are more structures that we could talk about, but those structures are more complicated structures. These are the basic structures that you will see around. So now let's talk about how do you want to structure your own assets? How do you want to structure in order to take advantage of taxes, in order to get tax benefits, in order to get asset protection, in order to be able to build more wealth. This is something I just drew here. I drew it because I didn't want to, I mean, it's easier for us. So basically, we have this thing called the trifecta. This is the way the top 1%, the top 3% of Americans, the top people in America who pay zero in taxes, they all structure in this way. So here, the foundation of your estate, the foundation of everything you do is generally, from a legal standpoint, is something you call a revocable living trust. That is why many of us, I mean, this thing called trust has generally been looked upon as something that belongs to the wealthy. But it's basically one of those things that it's been kept as a dark secret for many of us. A revocable living trust is that thing. A trust gives you privacy, and it gives you one thing that it gives you privacy, and it basically avoids you a lot when it comes to things like probate when you have a trust. With a trust, you have the trustee, which you have basically you have the owner of the trust, which could be you or the both spouses in a family. They could be co-owners of the trust. Then you have something called the it's a living trust. In the case of a living trust, both spouses are generally the trustees of their own trust. In that case, they also have to have a successor trustee, which could be an institution, or it could be also what? It could also be an individual, somebody in the community that you trust. He becomes your trustee. What does that do? It means that if you are not there, or you become disabled, or something happens to you and you are no longer cognitive to be able to operate your activities, that person is going to step in. And so you have the owners, you have the trustees, and then you can now design the beneficiaries. The advantage of this is that you can do anything. You can basically instruct anything you want. And it is the best vehicle to really transfer assets from one generation to the other in the most tax efficient manner. That is the advantage of a trust. It also provides you that privacy, because a trust is a private document. Once you've approved your trust, you got it notarized, you got it witnessed, it's a private document. Unlike a will, when you have a will, it has to go through probate. And the probate court system is a very complicated system. So basically, when something happens and you're no longer there, your assets, your estate is basically frozen until the probate court decides, approves the will before it can be executed. But in the case of a trust, the trust is executed immediately. And for those who've gone through probate, they know exactly what I'm talking about, because probate is a very complicated system. Then, the foundation of your estate from a tax standpoint is your personal income tax return. Is that document that you call a 1040. That is the document that gives you access. Most people think that the 1040 is basically a document for compliance. I'll tell you, 1040 is the most important document that gives you access, that helps you build wealth. It helps you build assets. It gives you access to other people's money. Because when you want to buy any substantial asset, what they're going to ask you is to your tax return for the last 2-3 years. So tax returns is that document that gives you access to other people's money, and it gives you access to those assets, to acquire those assets that are going to generate wealth. That is why it's the foundation from a tax standpoint, and it's that foundation that allows you to be able to build wealth. Now, having had those two sitting at your foundation, you want to divide your estate into two. On the right side of your estate, you have an LLC, you have what you call assets. This is on the right side. You have all those assets. What is an asset? An asset is anything that is a passive activity. Anything that creates money for you while you're sleeping is called an asset. And when you have asset, basically with asset, what you're doing here with the asset is that assets give you, what do assets give you? Assets will give you, those are those things that will give, this is what you call wealth. Wealth is basically the net assets, the difference between assets and liability. Operation side is anything that you're actively working on in generating money. So while the assets are creating wealth for you while you're sleeping, the operations are those things that you are actively spending your time doing. I sit here, I come to this office to work. I spend 10 hours here. That's I can only work for as much. The assets are working all the time. So on this side here, your assets could be, your operations could be your W-2, that's where you're working your day job, or you could be a business where you have a sole proprietorship. You start with sole proprietorship, and then there you have an LLC. Then the LLC, when you start making money in the LLC, you have an S Corp. That S Corp will own its 1065, which is basically a partnership where you are actively involved, where you're a general partner. All this is owned by your revocable living trust. Remember, the trust owns everything. You own the trust. That is the structure. Now, on the side of your assets, you want to have maybe an LLC. You have this LLC. Why do you have an LLC? For asset protection purposes. The LLC holds your rental. It holds your cryptocurrency. It holds your stocks. All those things are held within the LLC. Now, the LLC itself will own other entities. So basically, it's also owned by your revocable living trust. So the trust owns everything, and you own the trust. That is the structure. I told you, operations tend to pay a lot in taxes. They generate something called income. W-2, 1099, you pay a lot in taxes. But the objective, these incomes here, even though you're paying taxes, this is where you're working. The assets are what you really want to build, because you will need those assets to create passive activity when you are no longer active. This is what creates wealth for you. So our role is really to help you structure your income, structure your operating income, and basically strategically use them in acquiring assets for you. These are the assets that are going to be there for you when you need them the most. Now, on here, I have made this small quadrant here. This is what you call the tax quadrant. Again, we're talking about structure here. We're talking about structure. This is, some people, they call it the trifecta. Some people call it the T structure. When I make this, because we all are part, we all belong to this quadrant here, this quadrant, which is on the left, on the lower left of the table. On the E represents employees. When you are an employee, you're basically, if you're a higher income earning employee, you're paying 37% of your income is going, up to 37% of your income is going to the IRS. And if you're in a state where you're paying state taxes, another between 5 to 13.3% is going to the state, depending on the state in which you are. I know California is about 13.1%. Other states, you have 12%, or depending on your state. So if you think about only 37% plus maybe 9% in the state where you are, as a high income earner, you're paying about 46% of your income is going to taxes. 46%. So as when you are an employee, and this money, the IRS and the Department of Revenue, they receive the money before you even see your own share from your W-2. Basically, that's not where you want to be. You're paying too much in taxes. So what people do, you go and then you become a specialist. You become a 1099. You have a contract, or you create a business. You create some sort of a business, maybe an LLC, and then you start your business. When you start that small business, you are a sole proprietor or whatever. You are paying already. The advantage you get there is that you are going to now be able to deduct expenses which are ordinary and necessary, and also are expenses that are reasonable in the pursuit of income. So you deduct those expenses related to the business, but the other thing that you get here is that you may be having to pay something called self-employment tax. It's an additional 15.3%. You want to run away from that. So people, smart people, you want to run away from here. That's why people create structured businesses. They have maybe a C Corp. And then if you have a structured business in America, you're paying a flat rate of 21%. You get your expenses written off, you're paying a flat rate of 21%. The problem you have here is that every time you take money out of that C Corp, out of that entity, you're going to pay on your dividends. So dividends, that's why we say that C Corps give you double taxation. But it's already far less than what you were paying on the two first quadrants. The last quadrant is where most investors are. People who are in this investor quadrant. Those are the people we call the smart people, the top 1%. They tend to pay about 0% in taxes. These are the wealthiest Americans. These are the people who make the most money. But they are smart enough to be working with strategists, and they are avoiding taxes. The main thing, our main goal here is to basically make you be able, and this is very important. We make you be able to strategically move this income, which generally pays a lot in taxes. We move it on the right side where you're building assets. You're not only building assets, but you're structuring those assets. And if you're structured properly, all the costs related here, the principal, maybe you bought an asset, a rental property, the principal, the interest, the taxes, and the insurance, the expenses are all pushed over to guess who? To the middle class, to those of us who are using those assets that belong to those people, and they end up paying 0 in taxes. That is exactly what we want. That is exactly the game we play. So basically, we are moving you from here, strategically making you an investor so that you're paying almost 0 in taxes, so that you're trending towards paying 0 in taxes. Are we together? Are we together? I just want you to send some emojis to let me know that I am with you. I need to know that we are together. I'm not speaking to myself. Now, this is something that I scribbled here. I scribbled this because we are talking about something that's very important here. We're talking about how we can use leverage, or we can use real estate to leverage other people's money and win. Real estate, in real estate, you are basically winning on the back of the middle class. You're basically, let's take this example here. Mr. A wants a property. He wants a property worth $1 million from Mr. B. What he does is he only has 100K, but this property is worth $1 million. So he steps to the bank. The bank is full of other people's money. The middle class have all their money sitting in the bank. So now gets to the bank and gets 900K to add to this 100,000 that he has, the 10% down for getting access to this property. Now, A pays B $1 million and acquires the asset for $1 million. That asset is automatically put on the right side of his trifecta for $1 million, even though his investment was only $100,000. So let's assume that A basically is, let's say A had a W-2 income for $250K in that same year in which he did that. If he meets certain criteria, and this is very important, the criteria is what we help you do. If he meets certain criteria, Mr. A, this $250,000, he's going to pay about $70,000 in taxes out of this money. But if he meets certain criteria, even though he can take the whole $1 million, even though he only invested $100,000 in this money, he can take the whole $1 million, cost segregate that property. And what you want to remove here is basically the land. You cost segregate the property, and then a portion of the property, which can go up to, I mean, it can be a significant number, but generally I just took 25%. 25% is about 225. He can basically reduce that 250 W-2 income that he made, on which he was going to pay $70,000 in taxes. Now he can reduce that. He can basically deduct this through something called depreciation of that property. He takes depreciation of that property and he writes off 225. And now he's remaining with just about 25K in taxable income, which leads him to paying zero in taxes. That is the game. That is what we call the American dream. That is what the wealthy play in America. So assets are the things you want to play with to acquire, to be able to avoid taxes. Wealthy people have assets. They are able to leverage those assets to play against their ordinary income. That is very important. I wanted to make sure we understand that. So in real estate, you are basically winning on the back of the middle class. You're using the money of the middle class to win. This is important. So let's talk about how to structure your rentals. I just talked about rentals. Some of the things I'm going to be talking about here, rental property should never be in an escrow. Very important. I see a lot of clients who come to me here. They have rental properties that they have put inside escrows. No. Your rental property should not be in an escrow. No rental property, no escrow for rental property. Never have them in an escrow. You cannot refinance with, the reason with this is that basically, when you have your assets, if you have a rental property in an escrow, the way this works, normally when you have them in your LLCs, you can basically, if you want to refinance that property or take money out to do something else, you basically can refinance that property by yourself. And then there is no implication, there's no taxable event. But when it's in an escrow, because when you go to the bank will, the lender will not lend money to the escrow. They want that asset that's sitting in the escrow to be transferred to your name. And if you are transferring a property, let's say you had a property, let's say you had a property which you bought for $200,000 a few years ago, and that property is now worth $500,000. The equity in that property is $300,000. If you wanted to refinance that property to get some money out, what happens is that the tax situation, and I'm just telling you, this is just one of the reasons. There's so many other reasons. What happens is that when you go to the lender will want you to basically, they cannot refinance it to an escrow. They want it to be under your name. And if you want to deed that property to your name, it becomes a taxable, it is considered a sale. The IRS considers that a sale. And if you sold that property, if you do that, in many instances, you might just do that and think that there's no tax event because it was. But what happens is now you have sold a property which is now worth $500,000, which you bought for $300,000. There is a capital gain of $300,000 for the sale of the property, that equity that was in the property. That equity will generate a tax of another $60K based on capital gains tax of what? Of 20%. You have to pay a tax on that equity. If you had done that with an LLC, there will be no taxable event. That is just one of them. I can talk about a second one, a third one, and fourth one. But this is the most important thing. When you have assets that are growing in an escrow, it becomes a problem for you to basically take those assets out of the escrow. There are ways to do that, very, very, very technical, and I leave that to the attorneys. So they should be in an LLC. How to structure your rentals, they should be an LLC. Some states have better protection than others. I just told you about COP entities. COP entities, they are stronger. They are stronger asset protection. LLCs are stronger. They give you better limitation of liabilities in some states than others. But generally, LLCs will give you protection of your assets. There are 5 states with COP entities, COP LLC, as far as I know. There are about 5 states that have COP LLCs. And then also another thing I see all the time is most people don't know, because the question that usually comes is, how do I have, or do I have to have LLCs? Do I have to have each of my property? Do they have to be in an LLC? The answer is yes and no. When I think about that, when we think about putting assets or rental properties in an LLC, we are always looking at the equity that is involved. You want to look at the equity, you want to look at the risk. Most importantly, the equity. If I have 5 rentals and each of those rentals have equity of over $100,000, I want to have each of them in LLCs. I want to have each of them in separate LLCs. But if I have 10 properties and all those 10 properties, all of them don't have equity. Maybe I just bought them. I've taken all the equity out. The business is it's still, maybe I have $20,000 of equity in there. I can now join maybe 5 LLCs together. Well, 5 entities in one LLC. The problem has to be the equity. What is your asset at risk? That is so important when it comes to grouping real estate into LLCs. The LLC should be owned by a revocable living trust. Very important. You want to deed those assets, you want to fund them to the LLC, to the revocable living trust. Remember the structure I gave you? You are basically already shielding your rentals with an LLC. You want to give that additional layer of privacy to that rental property by owning it through a revocable living trust. So another thing, so again, how to structure rentals. We talk about, again, this is something that you'll see a lot in terms of taxation. When you think about taxation, most of the people who come to me, they're trying to get, okay, they have all these they have tax issues, they're paying too much in taxes, and they're trying to look for ways to avoid taxes. One of the things that is out there is a short-term rental. Short-term rental give you access to something. We have the short-term rental loophole, which allows you, even though you are not a real estate professional, to be able to cost segregate and take bonus depreciation and write off your ordinary income worth. It is a big part of it is a big thing. It requires you to be involved in that activity, in that rental property. It requires about 100 hours. You have to show that you had 100 hours in that activity and you materially participated beyond more than any other person in real estate related activities on that property. Your participation is more than any other person. These are, what are the risks? You're always thinking about those. Then another one is long-term rental. For long-term rental, you must meet the rep status, which is real estate professional status. And this is for either you or your spouse. It talks about 750 hours in real estate related activity. And then your principal occupation is in real estate. Many people who don't meet one of them may qualify for the second. And it all depends on how we strategically structure you so that you can take advantage of it. I hope this is making sense. So this is what I wanted to talk to you about today. I gave you 2 things. The key things we talked about were around, we talked about why is structure so important. We gave you the details of why structure is very important. You want to think about the risks. You want to think about what you want to achieve. Structure is structure is everything when it comes to taking advantage from a tax standpoint, taking advantage from an asset protection standpoint, taking advantage from a wealth building standpoint. It's so important. You think about structure. Structure is key. And most people come to me, people just register companies without understanding why they are. Structure is everything. When you want to build a house, you think about the house you want to build. If you want to build skyscrapers, you want to start by thinking about the foundation. The foundation of all these things is the structure. That's why structure is so important. Another thing, how does it affect rental properties? How do I basically structure my real estate? How do I get you want to put your rental. We talk about LLCs. We've talked about co entities. We've talked about how you can basically use real estate to mitigate taxes, to build wealth, and also basically you are the guy who is using other people's money to mitigate taxes. I guess this is what I had for today. If this makes sense to you and you think this is giving value to you, please, we are here. We talk about these things every day, every Friday at 4 p.m. You can contact us. This is our contacts. These are our contacts. You can get this our website if you want to get an appointment with me. You go to our website, www.chnadvisors.com, and you can book a free discovery call so that we can talk about your circumstance. You can follow us on Facebook. We are always sharing very critical material on Facebook. We also have very critical material on Instagram. So if you like what we just talked about today, you may want to go to this platform, follow us so that you don't miss any of our episodes, you don't miss any of the materials we're sending. And if you are out there and you have a particular topic that is of concern to you, even if it's a topic that I don't have expertise over, I am going to make research on that topic and I'm going to talk to you about it. Thank you so much. I appreciate it. And if you're out there, you can also scan the QR code. This QR code takes you straight to our website and you are able to contact us and you're able to see all our materials. Again, my name is Charles Ndroya. I'm a CPA. Let me stop sharing. Again, my name is Charles Ndroya. I'm a CPA. I run this company called CHN Advisors, which is a company that we basically out here helping you guys, helping businesses, helping business owners like yourselves, helping all of us to be able to move to the top 1%. If we do these things, I am certain that within 5 years, within 7 years, all of us will find ourselves in the top 1%. That top 1% is for everybody. So I hope this brought a lot of sense. If you are out there and this made sense to you, please just give me a shout out so that I know I'm talking to real people. I want to know I'm talking to real people. Yes, I need a shout out. Did that make sense? If it did, let me know. If you want us to be doing this more and more, we're going to be doing more. Just leave us a shout out. Thank you, Kim. I appreciate it. Thank you so much. Thank you so much. If you have any question, we are here. I'm going to take 1 or 2 questions. If anyone has a question, I'm available for the question. Any question. Thank you, Gilbert. Thank you, Gilbert. Thank you, Kim. Thank you, Nadine. Thank you, Evaristus. Thank you, Philomena. Thank you so much, George. Thank you, Charlene. Thank you, Toyin. I appreciate you, Besso. I thank you, Sylvie, Shalanda. I appreciate all of you. Thank you so much. Thank you. If you want to contact us, it's easy. You can contact us and then we can book appointments to talk to me one-on-one so that we can see your particular situation. Thank you. You have an excellent rest of your day. Thank you, Ms. Rain, for sharing our website. Again, for those who don't know, you can go to our website and there's a lot of information there. Follow us on Facebook, Instagram, YouTube. We are all there. Thank you. You have an excellent rest of your day. Bye-bye, and see you next week. Bye to everyone. Bye-bye.